Okay, we can probably just get kicked off with the housekeeping points just to begin with. So before we begin in earnest, this session is being recorded, and as usual, there will be a link to the recording which will be shared afterwards, and I think also a copy of the slide deck too. But just in that vein, please do keep yourselves on mute and off cameras if possible. The session is in for an hour, and we do really want to get your thoughts and feedback as we go along. So if you do have any burning questions, then please do feel free to pop them in the chat, and we'll try to pick those up towards the end if we've got time. But there is quite a lot to get through, as you'll see, and as usual. But I think it's probably even more so in this version of the grid. So I think we probably just crack on. So delighted to share with you today our highlights from this year's Financial Services Regulatory Initiatives Grid, also known as the RIG, and we were having a bit of a debate before this about what we will call it, but there are essentially different ways of treating it, but we will term it the RIG or the grid. It is quite a technical sounding document, but essentially it's the roadmap for what is in the pipeline for financial institutions for the next 2 years. And this latest edition was published on the 14th of April by the Financial Services Regulatory Initiatives Forum, which brings together 9 of the key regulators in total. That's the FCA, the PRA, the Bank of England, the Treasury, and also others like the ICO2, the Information Commissioner's Office. And already in the 7 weeks since the grid was actually published, there have been loads of progress on the initiatives that we were planning to cover already. And I think even just in the last 24 hours, there've been some updates. So we've been frantically trying to scramble to make sure we can give you the most up-to-date position on all of this. But I think first, let's just acknowledge how much is actually on the regulatory agenda right now. We've got 80 pages with some of it exceptionally small font, and the new grid lists 144 regulatory initiatives planned for the next 24 months. And nearly half of those are brand new additions. So that's really quite a heavy pipeline of change. And if you stop to think about how much has shifted across all the different sectors since the RIG was first published in mid-April, so not even 2 months ago, it just shows how fast-moving the regulatory change agenda continues to be in the UK. And a lot of that is driven by government policies, as we'll see. So we've got big ticket items like the Government's Consumer Credit Act reform, the Treasury and FCA proposals on crypto assets, and a second consultation on the consumer composite investments, which is set to replace the UK's PRIIPs regime, as well as launching other initiatives the FCA has done recently, which aren't covered in the RIG. Examples of that would be the live AI testing service, which they've just had an engagement paper on. And also publishing the results from the Financial Lives 2024 survey, which has lots of interesting information on cross-sector and sector-specific levels. So we've got, I'm not sure if we've got the slides up, but we will turn to the agenda. It's certainly not up on my screen. We'll get that up if not. But yeah, just a couple of points I'd like to point out before I hand you on to our fabulous speakers who are going to dive into the. Apparently it is working, so that's good. So a couple of topics I just wanted to sort of highlight before we move on, which I think is quite important, just to give a sense of industry direction and the regulators' priorities. The FCA has been sharing publicly that in line with its 5-year strategy and its general aims as a regulator, they are working at pace. And a key part of what that pace means is that the FCA is aiming to have a shorter time frame in which to respond to consultations, which means the industry will itself have to respond more quickly to those consultations. Linked with this, we can expect to see the FCA doing more pre-consultations and industry engagement, perhaps in ways that we haven't seen to date. And so, it's fully expected that some of the firms on this call may be asked to support some of those engagements. Secondly, Chancellor Reeves has confirmed that the UK's financial services growth and competitiveness strategy, they always use the catchy names, will be published after her Mansion House address in mid-July. That's the 15th of July. And that strategy ties into the fact that financial services is a key part of the government's wider UK growth agenda, and yet another reminder of the increased political interest in financial services. And an increasing proportion of regulatory initiatives and activities are now driven by government. I think 19 of the initiatives that are in the RIG result from the repeal and replacement to retained EU laws under the Financial Services Markets Act 2023, for instance. Another striking feature of this grid, before I hand you over, is its breadth of scope. It's not just about one sector or a handful of niche regulations. It's across the board. And two of the largest sections in the grid are multi-sector and banking, credit and lending. And that means that many of the changes affect multiple parts of the financial system at once, rather than isolated, siloed rules. And that's a big deal, and I think signals intent for a more integrated approach to regulatory change, tackling themes that cut across the different sectors like banking, insurance, asset management, payment firms, you name it. And when the multi-sector category is as hefty as banking, that tells us that there's less emphasis on narrow sector-specific tweaks and more on wide-ranging reforms that require coordination across the industry. That's not to say there aren't sector-specific aspects to this, which are really important to stay on top of. It's just a signal that there are quite fundamental changes at foot. And I think that's probably an opportune moment to hand you over to Jake Wilson to get started with the deeper dives and the multi-sector priorities.
Jake. That's great. Thank you, Jamie. So just to give a very quick introduction to myself, my name's Jake, and I'm a senior solicitor within the Financial Services Regulatory team here at Burness, and I'll be covering the multi-sector priorities that were included in this year's iteration of the RIG. So to start us off, the first one that I wanted to raise was the changes to the anti-money laundering regulations. So this is one section that was actually included in the previous RIG. So whilst I've generally tried to focus this section on initiatives that were new to this April's edition, anti-money laundering is such a pertinent topic across the financial services industry that is something well worth highlighting any upcoming changes on it. So this initiative is following on from the Treasury's wider programme aimed towards reducing money laundering is set out in its economic crime plan for 2023 to 2026. So the kind of steps that we've seen in this were the Treasury publishing a consultation between March and June last year, where they were looking to improve the MLRs, and this consultation largely covered issues in the MLRs that had been identified back in 2022 as part of the review of the anti-money laundering regime. And the consultation covered 4 core themes, and these were looking at making customary due diligence more proportionate and effective, strengthening system coordination, providing clarity on scope of the MLRs, and reforming registration requirements for the trust registration service. So these are the kind of areas that they're looking to see what they can do to strengthen the MLRs and overall provide a more robust regime. And the next steps to kind of be looking forward to on this one is that now the consultation finished back in June last year, the government's aiming to bring forward these changes into the MLRs sometime between sort of 2024 and 25. So the kind of end of this year is where we're going to be most likely looking at these to begin to be implemented. So then moving on to the next one is the initiative that was focused on modernising the redress framework. So this really all kicked off with the FCA and the Financial Ombudsman Service making a joint effort to modernise the system. And as part of that, they launched a call for input where they were seeking views on how they can improve outcomes for consumers, but also provide greater stability to firms so they're better able to innovate and have a general more powerful service offering. So we've actually seen movement on this as recently as just yesterday, as on the 4th of June. The Ombudsman launched a consultation on interest rates that are applied to the compensation awarded to customers. So this is something that came following on from the call for input that suggested that interest rates charged for awards from the Ombudsman could be aligned with the market conditions and reflect the market conditions. So on the back of this, the Ombudsman suggesting the interest rate will actually track with the Bank of England rate base rate plus one additional percent. So the initiatives grids can also set out that this is looking like it might be the first of a few here. So there's intended to be further milestones planned between July and September. So we're likely to see at least one more consultation between now and then, and then really to that push to try and improve outcomes for consumers and improve stability for firms. And it's something we've seen already this year, where the Ombudsman introduced the flat fee for claims coming in from claims management firms. So you can really see that there's this push to sort of change the overall redress scheme for both firms and customers alike. So then moving on to the next one, we had the review of the consumer duty requirements. So this has been proposed in support of the FCA's international competitive and growth objective. So we're 3 years now from the first introduction of the consumer duty, 2 years since it began applying to open products, and 1 year from its application to closed products. And now that the FCA are in the midst of trying to simplify the requirements for firms under the duty. So this process began back in July 24, and where they published a call for input on what they could do to simplify the requirements. And in March of this year, they published a feedback statement. They're setting out the actions that the FCA is going to take in order to progress this. So in March, the feedback statement, the FCA was committed to launching a consultation and discussion paper on mortgage changes, and this sort of went on from May till June this year. And they were looking at areas such as risk appetite and responsible risk taking, as well as alternative affordability testing and product innovation, just to name a few that they were looking at within the mortgage industry. And then beyond that, the feedback statement also set out the FCA's intentions to review the promotion rules for consumer credit, and this is particularly contemporary, seeing as the Treasury's ongoing review of the Consumer Credit Act. So looking forward beyond what they've kind of already taken, that they're looking to use an accelerated consultation process to act quickly where there's clear cases for change and things that they can resolve quickly. But then there's also further plans, in addition to what I've mentioned here, is that the FCA is also planning to host an in-person summit this summer, as well as publishing a statement outlining their full program of work in September of this year. So there'll be a few things in the immediate and sort of short-term future that are going to sort of shape what direction any simplifying changes to the consumer duty are going to look like over the next year or so. And then the final initiative on this slide that I wanted to cover will be just a very quick run through of the premium finance review. So for those of you who aren't familiar with premium finance, it's really simple. It's just a product that allows for people to pay their insurance premiums in installments. And the FCA had already launched a market study into the premium finance industry back in October 2024. Here they raised concerns that premium finance may not be representing fair value to customers and that competition may not be functioning effectively. So even though this wasn't a formal consultation, stakeholders in the market were still invited to give their views by the end of November. And for the next steps planned were for the FCA to begin to engage with firms on what data they'd need in order to come to a conclusion for that market study. So what the rig set out is that we're hoping to see an update on this by the end of 2025. So as we're in June, the first half of 2025, that is. And so now that we're in June, it'd be something we'd expect to see very shortly that'll begin to shape the next steps the FCA are going to take in terms of their review of the premium finance market. So moving on to the next slide, the first point that I wanted to cover here was the cash short-term improvements. So this is actually something that was raised by the as part of the overall consumer duty review. So one point that the FCA raised in its feedback statement, and I mentioned it earlier, was there was looking to do an amendment of the client asset source book. So as part of this, the FCA stated its intention to consult later this year on changes to the client asset source book. And some areas that the FCA will be looking at will be amending the record keeping requirements for certain due diligence relationships, and also broadening the reconciliation rules so that would allow for records from sources that weren't originally envisaged when the rules were introduced to be used in record keeping. And then the next one I'll move on to is our enforcement guidelines. So the FCA had been looking at revising their enforcement guidelines for a while now, and the movement really picked up on this following the consultation on this in November last year that closed in February 2025. And they followed up on this with a letter to the Treasury Select Committee, where the FCA confirmed they're not going to be taking forward the proposal to shift from to a public interest test for announcing investigations into regulated firms, and keeping with the current exceptional circumstances test for announcing investigations into regulated firms. But they did confirm they were going to be taking forward other aspects of the transparency proposals where there was enough support for them to do so. And this, again, had some movement very recently, as this came to fruition yesterday, and they published their updated enforcement guidelines. And in this, it was a huge amount of sort of simplifying and streamlining, where they removed any duplication where they could. But also crucially, they identified a few situations where there was broad support for an increased transparency in what investigations they were doing. So one example that they gave was where there was unauthorized financial services being offered, or offences of unregulated activity. And this was really going to be done with a view to warn consumers to avoid these unregulated activities, or as well as actually to help the investigation, to help people come forward to assist them with it. The next one was where the investigation had actually already been made public by the subject of the investigation, or potentially by an affiliated company or a regulated body or government or public body that were associated with the investigation. So in a way that the FCA are saying, where it's already out in the public domain, yes, they'll then confirm that they have an ongoing investigation into the regulated firm. And the final one is slightly different, as they are going to make anonymous announcements, where they would not be naming or identifying the subject of the investigation, but they'd be giving hints as to the kind of types of misconduct. And the idea of this is that they'd be able to educate people on the types of misconduct that are being investigated. So both to the benefit of the firms and for consumers, so they'd be sort of wary of where there was any kind of misgivings within the financial services industry. But one thing to note on this, that these changes do only apply for investigations launched from yesterday. So for any launch before the previous guidelines would still apply to these. And the final point that I was going to cover was on PICES. And this is a new addition to the RIG, and has seen developments since the RIG was published in April. So PICES is the Private Intermittent Securities and Capital Exchange System. And it's a new type of private stock market which facilitates the trading of private companies' shares on an intermittent trading basis. So this is a reform which supports the UK government's growth objectives and improves private companies' access to capital markets. And on 15th May, the Treasury published their the regulation, which is SI 2025/583, which follows on from their draft from November last year. And what this does is establishes a framework that will enable the FCA to operate the PICES sandbox to test the new legal framework. And the plan is for this sandbox to last up to 5 years, so until 5 years to today, actually, with the possibility of extension of the sandbox via further legislation. Alternatively, the Treasury can make permanent amendments to legislation subject to parliamentary approval, of course, before the end of the sandbox. The FCA has also confirmed they will publish their final PICES rules in June this year, so expecting something soon. And this came following the December consultation. So, and then another recent development has been in April, the FCA setting out its feedback received to their consultation and set of changes that they're inclined to make towards their original proposals that were in their policy statement. And then in addition to all of this, the FCA also opened their pre-application support to those who wish to be a PICES operator, and where firms can get feedback on their model before starting their formal application process, which will be available after the FCA's final rules are published. So we'd like to hear from anybody who's looking to apply for an operator to see what kind of the general opinion is of those in the industry, and what steps are being taken as part of this. So thank you for listening to my part, and I'm going to pass you on to my colleague Sylvia, who's going to talk about crypto assets and payment priorities.
Thanks for that, Jake. So I'm Sylvia. I'm a senior solicitor in the team. And as Jake says, I'm going to cover the payments and crypto assets section of the regulatory initiatives grid. So this section contains initiatives which it says and the summary are aimed at promoting competition, innovation and protections in payments to improve the quality and security of services for consumers and businesses. So let's deep dive into just a handful of those initiatives, starting off with crypto assets. So since the GRID's publication in April, we've seen a real flurry of activity relating to the proposals for a new regulatory framework for crypto assets. We had already seen some steady activity where crypto assets are concerned, from the application of the money laundering regulations to certain crypto asset activity in 2020, to financial promotion rules encapsulating qualifying crypto assets promotions in 2023, among some other things. But the GRID now sets out what further work is on the horizon and also links up with the crypto roadmap, which the FCA published in November 2024. So what we can expect to see is a lot of activity throughout 2025, with the RIG indicating that we should see at least one discussion paper and 4 consultations from the FCA planned for this year, and Treasury legislation being laid to bring crypto assets within the regulatory perimeter. And the FCA and the Treasury haven't hung about. Since the GRID was published in April, the draft Treasury legislation, which is a key milestone, it's since been published and it is expected to be laid in the second half of 2025. That draft order proposes to bring new regulated activities within the FCA's remit by amending the Regulated Activities Order, the RAO, in the usual way. That draft order introduces new specified activities with corresponding exemptions for qualifying crypto assets under FSMA. It was published on the 29th of April. The draft legislation and policy note sets out the parameters of regulated crypto activities and is drafted to bring exchanges, dealers and agents within the regulatory perimeter. It creates new categories of specified investment and specified activities for crypto assets. And as mentioned, the Treasury intends to legislate for the new regime by the end of this year. And following hot on the heels of that draft legislation, the FCA published a discussion paper detailing its proposals for the regulatory framework governing crypto asset activities in the UK, which aims to elaborate on the legislative framework. And then even more recently, on the 29th of May, the FCA released 2 consultation papers, one which is consulting on proposed rules and guidance for the activities of issuing and safeguarding qualifying crypto assets, which would include qualifying stablecoins. And the second is a consultation on the proposed prudential regime for crypto asset firms. It's worth noting that the Treasury has previously confirmed that it does not intend to bring stablecoins into UK payments regulation at this time. So unsurprisingly, the consultation paper doesn't include proposed requirements for firms carrying out payments using qualifying stablecoins. So both of those consultations can sort of be read together, and the consultations will close on the 31st of July 2025. So it's very much hot off the press, but we can expect to see more. We can expect to see further consultation papers during this year, and those should deal with custody arrangements, so arrangements around record keeping, reconciliations, segregation of assets, and the use of third parties. We can also expect to see consultation papers on conduct and firm standards. So that would include systems and controls, consumer duty, conduct rules and governance, and once those consultation papers have been published, the final rules are expected to be published in 2026. And then we'll have gateway readiness and gateway opens, and if all goes to plan, then the new regime will go live in 2026. So moving on to payments, so that's the next slide. Thanks, Jake. So as usual, we've got quite a lot going on with payments, so we'll just take a look at a couple of those key initiatives. So it was back in October last year that the authorised push payment APP fraud reimbursement scheme came into force. So just as a quick reminder, the scheme requires in-scope payment services providers, so PSPs, sending payments through either the Faster Payment System or CHAPS to reimburse customers if that customer is sending payment, but they've fallen victim to an APP scam. It's subject to certain exceptions, and which includes that the customer needs to satisfy the consumer standard of caution. So what's next? Well, the payment systems regulator had intended to consult on the reimbursement of claims management system in April this year, but that has since been pushed back. But we should expect to see that soon. It's detailed on the grid, so we're waiting that one. We can also expect to see the maximum reimbursement level of the scheme, which is currently set at 85,000, but we expect that to be reviewed in the final quarter of this year. But we'll have to wait until early next year in 2026 to see the independent 12-month post-implementation evaluation of the PSR's reimbursement scheme. That should give us a fuller sense of how effectively the scheme is working. And feeding into that evaluation, no doubt, will be the Labour government's expanded fraud strategy. That's timetable to be published this year, and that should inform how effectively APP scam prevention is working. So a few things to come, a few things on the horizon, and it will be interesting to see if the regulator does think that PSPs are really doing enough to help their customers not fall victim to APP scams. The PSR has, of course, ultimately been abolished, but for the meantime, the government has confirmed that there will be no immediate changes to the PSR's remit or ongoing programme of work, and it will continue to have access to statutory powers until legislation is passed to enact its abolition. Okay, and moving on to another interesting initiative under this section, it's the development around smart data and open banking. So the Data Use and Access Bill, which is making its way through Parliament, is intended to grant the powers necessary to establish a long-term regulatory framework for not only open banking, but also future smart data schemes and financial services. So as a general overview, the bill is an assortment of data-related provisions that includes amendments to the UK's data protection regime, provisions covering smart data schemes and improving access to public sector data for the private sector, as well as digital identity verification services, and changes to the structure and functioning of the ICO. So fundamentally, the bill's aim is to contribute towards 3 key objectives. So it's to harness the power of data to grow the economy, to improve public services and support modern digital government, and to make people's lives easier. Oh, this is a good one. So once that bill has passed into law, it's expected to be in this summer, the Treasury will lay an instrument to create a smart data scheme for open banking, and that's expected to be in the first quarter of 2026. So this is all part of the journey of open banking, and it continues us towards the journey towards open finance. The next step for open finance is that the FCA and Treasury will publish a roadmap, sort of similar to the crypto roadmap, for the rollout of open finance. And it's expected that the regulatory foundations for that will be in place by the end of 2027. So one final initiative for me is on safeguarding. So namely, that's the anticipated changes to requirements for payments and e-money institutions. The FCA is proposing new rules to strengthen requirements for safeguarding of client assets by payments and e-money firms. In September last year, the FCA published a consultation with their proposed changes to existing safeguarding rules that apply to authorised electronic money institutions, EMIs, and payment institutions, PIs. The ultimate goal of that was to bolster and make clearer the safeguarding rules for payment and e-money firms, which should, as a result, minimise shortfalls in safeguarded funds and help ensure a timely payout of money to customers should one of those institutions fail. The proposals under that consultation had 2 stages, a sort of phased approach. There was interim rules, so these were designed to improve record keeping, enhance reporting obligations and monitoring, and improve governance and operational practices. Those interim rules they're intended to supplement the current safeguarding requirements in the PSRs and EMRs. Then there would be end state rules, which would significantly alter the current safeguarding rules into what has been termed a CAS style regime. And the proposed changes under the end state rules would include improved record keeping and reconciliation requirements, enhanced monitoring and reporting, and that would include additional auditing requirements. They would also enhance safeguarding practices, including how accounts would be designated. And they would also require the holding of all funds, assets, insurance policies, guarantees used for safeguarding to be held on trust in favour of clients. Now that consultation closed at the end of 2024, and it was timetabled that the FCA would publish interim rules and the accompanying policy statement in the first half of this year. We're still awaiting the publication of those interim rules, and it'll be interesting to see where they land following the consultation, especially given how significant the proposals were. The grid indicates that the interim rules are likely to come into force in 2026. The timing of the final rules is dependent on relevant legislative changes being made by the Treasury. So watch this space for those ones. Now that comes to the end of my section. I've just given you a snapshot of some of the initiatives under the payments and crypto assets section. And I'm now going to pass you over to my colleague Marianne, who will be picking up the banking, credit and lending section.
Thanks, Sylvia, and morning all. I'm an associate in the team here at Burness Paull. So as Sylvia mentioned, I'll be covering the banking, credit and lending section of the RIG. This features 21 entries, so I obviously can't cover them all. I've just picked out a few highlights within this section to discuss, and my areas will focus on aspects of consumer lending. So the first update is in relation to motor finance, and as I'm sure you'll be aware, the motor finance industry is facing a lot of uncertainty at the moment over the use of commission arrangements in car financing. The scrutiny over commission arrangements, or DCAs, discretionary commission arrangements in particular, isn't new. The FCA launched a thematic review into historic commission arrangements in the motor finance sector back in 2019, and then decided to ban DCAs in 2021. A lot's happened in this space since then, so most notably, 3 civil cases were considered by the Court of Appeal towards the end of last year against 2 lenders, First Rand Bank and Close Brothers. The Court of Appeal's judgment in these cases came as quite a shock to the industry. I won't go into detail of the judgment, but it has the potential to lead to widespread liability amongst motor finance firms wherever commissions were not properly disclosed to customers. These cases were escalated to the Supreme Court, and the court heard an appeal between the 1st and the 3rd of April this year. We're still awaiting on that decision. So the FCA already indicated that an industry-wide redress scheme may be required in order to address consumer harm. It has confirmed that it will decide on whether or not a redress scheme will be proposed and how this will be carried forward, if so, within 6 weeks of the Supreme Court's decision. And just this morning, the FCA published a new webpage which set out key considerations for implementation and scope of a potential redress scheme, such as whether it would be opt-in or opt-out. The FCA is clearly keen to hear from interested stakeholders, as it has invited feedback on key principles of a redress scheme or aspects of its scope, and it's offered a specific motor finance email address to which feedback can be directed. So there's not yet clarity on what any redress scheme may look like, if there will be one. However, the FCA has recognised the need to ensure fairness to consumers whilst maintaining the integrity of the market. And then in terms of the Supreme Court decision, we can't yet be certain as to when this will be issued, but it is anticipated to arrive early summer, so hopefully we can expect it soon. It will definitely be eagerly awaited given its potentially significant impact. So moving on, I'm going to mention buy now, pay later regulation. In the RIG, the FCA stated that the government was planning to lay the statutory instrument to bring currently exempt buy now, pay later products within the regulatory regime. Well, this arrived around 2.5 weeks ago on the 19th of May. The statutory instrument was published together with a response to the government's October 2024 consultation. The response to the consultation confirms that the government will proceed with plans to regulate buy now, pay later agreements, which are offered by third-party lenders, and these will be known as deferred payment credit agreements. I recommend reading the consultation response in full if you're interested in order to fully get an idea of what buy now, pay later regulation will look like. However, I'll briefly summarise a few key points of interest which arose from it. So while buy now, pay later products offered by third-party lenders will be brought within scope of the regime, finance provided by merchants will remain outside of scope. Currently, the government perceives the risk of harm in buy now, pay later to exist where third-party lenders are involved. But the government has committed to closely monitor the provision of buy now, pay later by merchants, and it will act if it identifies harm in this sector. Most CCA provisions in relation to information disclosure will be disapplied for buy now, pay later. This will allow the FCA to develop bespoke rules which are tailored to buy now, pay later lending. The FCA will be allowed to make rules on affordability and creditworthiness checks in the buy now, pay later market. Borrowers under buy now, pay later will be able to access the FAWS and benefit from protections under Section 75 of the CCA. And then finally, a temporary permission regime will be established to allow currently unauthorised firms to continue to offer buy now, pay later lending while awaiting full authorisation. So this will hopefully help to ensure a smooth transition without too much disruption to business. In terms of next steps, the legislation bringing buy now, pay later into regulation was laid in Parliament on the 19th of May. It must be approved by both houses before being finalised. So once the legislation has been made, the FCA will then have 12 months to consult on and finalise its rules. So regulation is expected to take effect around mid-2026. And then moving on to CCA reform, the 19th of May was a busy day for HM Treasury as it also published its long-awaited consultation on reforming the Consumer Credit Act, the CCA. This was in line with the expected timeline set out in the RIG. The government has decided to take a phased approach to the reforms so that it's able to consider the issues in sufficient detail without causing delay. So the work will therefore be split into two phases. The consultation that was published covers phase 1 and it seeks views on proposals in relation to information requirements, sanctions and criminal offences. The proposals aim to modernise the CCA, which is now 51 years old, believe it or not, making it fit for the modern age and to better align with developments in financial products and technology. The new regime will repeal many of the CCA provisions and recast them within the handbook as part of what's intended to be a more flexible, outcomes-based approach. But it is recognised that some provisions may have to remain in legislation. So I'll provide a very brief summary of some of the highlights from the phase 1 consultation, which HMT is seeking views on. So HMT is proposing to scrap the CCA's prescriptive information requirements, which have been described as complex and confusing and lacking in flexibility. The intention is to repeal all of the information provisions and for these to be recast into FCA rules. In relation to sanctions, HMT believes these are outdated, overly punitive and no longer necessary. It's therefore consulting on removing all sanctions from the CCA and instead relying on FCA supervision, enforcement and rules. And finally, in relation to the CCA provisions which give rise to criminal offences, such as canvassing off-trade premises or issuing circulars to minors, HMT is exploring whether it's necessary to retain some or all of these criminal offences or whether they can all be repealed. There are very few recorded convictions under the offences. The deadline for responses to the phase 1 consultation is 21st of July. The phase 2 consultation is yet to follow and the RIG indicates that we can expect it in Q1 of 2026. And phase 2 will consider things like the rights and protections within the CCA, such as Section 75, connected lender liability and unfair relationship claims. Given that we'll await responses to phase 1, followed by a phase 2 consultation and all of the steps that come after, it's likely we won't expect real change for a while. However, it's good that we finally have some movement in what's been a long-awaited overhaul of the consumer credit regime. So that's everything that I have time to cover in my section. I'm going to pass you over to Lindsay, who will look at pensions and insurance.
Great, thank you. Morning, everyone. I'm Lindsay. I'm a director in the FS Reg team. So today I'm going to cover the pensions and insurance parts of the RIG. Similar to what Marianne was saying, there's 25 changes in total across the pension and insurance sector. So I've just picked out a couple of those to go through. So we'll start with pensions. So adapting the FCA framework to a changing market. So the context for this one is a discussion paper from December, which closed in February this year, and the FCA is now reviewing the responses. So a consultation here is expected sort of towards the end of the year. And the kind of wider context is around the shift from defined benefit to defined contributions. So the main area of focus is really helping out individuals now that there's more focus on defined contribution and having to sort of take more responsibility for their pensions. So really trying to identify further work. For there, we might read changes to support customers in a changing market. So a couple of things that they'll be looking at are tools and modelers, which can kind of help support and drive engagement with pensions, and also trying to improve efficiency and consumer interest in areas like DC transfers and consolidation. So with quite a lot of what's going on with pensions just now, we're kind of seeing overlaps with some other areas. So I think this is an example where they're trying to do more in the sort of DC transfer and consolidation market as a result of increased engagement through the pensions dashboard, and once that's live. They're also in this area looking at SIPs. So there's been some examples of poorly run SIPs and poor outcomes. So the FCA is also considering some changes here to improve confidence in this part of the market. I think that also ties on to a couple of the initiatives I'm going to come on to around kind of some of the smaller schemes and some of the issues there. And it also complements the wider reform and government review and CP 24/27, which is the advice guidance boundary review. I'm not going to cover advice guidance boundary today, although we are expecting that consultation paper to be this month as well. So watch this space. So just wrapping up this section, the adapting the FCA framework to a changing market is really relevant for anyone and everyone in the kind of pension space. So the pension providers, investment platforms, trustees, regulated firms and advisors. So one worth keeping an eye on. The next one that I'm going to come on to is compliance with the obligation to assess value for money. So value for money is going to be a bit of a feature of the rest of the topics I'm going to talk about through pensions and insurance. So we're seeing a lot of kind of happen there, moving on from consumer duty. So this one is a regulatory initiative, again, looking at smaller defined contribution schemes who have been required to undertake thorough value for money members assessments and consider their future, if depending on the results of that assessment. So the initiative's been running from August 2023 and sort of wraps up towards the middle to end of this year. And that includes engagement with some schemes on value for money. So that one is really targeted towards smaller schemes, but it is related to the driving value for money in DC Pensions Initiative, which is the next one I'm going to come on to. So we've kind of spoken a lot already about how things have moved quite quickly on from the RIG. So this is definitely an example where there's a lot happening literally daily, because the pension scheme bill is expected to be laid before Parliament today. But just stepping back from that, because we haven't seen it yet, the context here for this one is CP 24/16. So that was kind of proposed rules and guidance for a new value for money framework for savers invested in default arrangements on DC schemes. And that's really about trying to give kind of more of a sort of more points of comparison and an objective way to compare the value for money across different schemes. It also includes some requirements in relation to asset allocation disclosures. So the areas of focus will be that schemes have to publish data on prescribed metrics and use this data for the sort of comparisons and assessments. and underperforming schemes will be required to improve or consolidate. It'll be interesting to see the output of the next consultation, because there was some quite strong feedback from some providers about the extent to which some of those aims would actually be realised in practice. But overall, the aim is to try and kind of shift from a predominantly cost-based view to a much more holistic and longer term view of the outcomes for savers. So it's not really about a sort of race to the bottom on costs, but really trying to evidence some of those longer term options and value across the board. So yeah, the key aims are to reduce the number of poor value schemes and drive better value for money and engagement, so people really understand how well their pensions are doing. So the FCA has been working with DWP and TPR as part of this work, and we're expecting another consultation paper probably pretty soon, tying in with what's happening in the pension schemes bill, because legislation will be required for trust-based schemes. So the idea is that the requirements will apply across the board for trust-based schemes and contract-based schemes. We've also had the final report on the pensions investment review, so that was just last week. So yeah, a lot happening in this space, and that was a joint effort from the Treasury, DWP, and Ministry of Housing, Communities and Local Government. And the implementation of the measures there will be through the pension schemes bill. So you might have seen some of these points in the press already, but the focus really is on kind of economies of scale, helping to enable greater expertise and also diversification and investment. So that's really the government having some involvement there and trying to increase investment in private markets and so on. We'll also see the detail, I think, of the sort of master trust super funds. So having minimum amounts of 25 billion in assets under management by 2030, and a kind of further recognition there about the sort of quantum and benefits of scale starting to be realised. Competition is not being ignored though, and there will be some transition pathways to sort of allow others to achieve scale where they've got a credible plan, and also a new entrant pathway. One other thing which we're expecting to be in the FCA consultation is a contractual override. So sometimes schemes have had some challenges in trying to make changes because of, even though the changes might improve things for customers, but just because of the wording in the T's and C's and sort of customer inertia and trying to get more involvement. So we are expecting to see a contractual override, which will be an interesting one to watch. So definitely a lot happening in the pension space. And as Jamie mentioned, we await the Mansion House address on the 15th of July. So yeah, so it's all happening with pensions. Moving to insurance, quite a lot happening here as well, but maybe not quite so much on the consultation paper and policy statement front. The first one I'm going to cover though is the simplification of insurance rules. So the RIG confirmed that a consultation paper would be published in H1, and it has been. So for this one, we are reviewing the consultation paper, but that was published on the 15th of May. The FCA also ran a webinar yesterday, which I think if you missed that, it will be uploaded to their website shortly. But that was really helpful, just in terms of explaining some of the sort of key aims and objectives. And there was quite a lot of questions and answers as well, which were quite interesting. So definitely worth listening to that if simplification of insurance rules is an area of interest. I think this one is also interesting in the context of the sort of FCA's wider plans to simplify the rule book. So we're starting to see some traction with that, and they're removing some of the requirements, which I will come on to. We're also seeing in this area the sort of increase in pace of change. So Jamie mentioned that at the start as well. And just in terms of the sort of timeline for this one, we saw the consultation paper published on the 15th of May. That closes on the 2nd of July, and we're expecting the policy statement later this year, and the changes will take place immediately once that's published, so there won't be the sort of usual transition period, although because these rules are about simplification, hopefully that'll be a good thing for firms. So in terms of areas of focus and what's actually likely to change, the first one is determining the rules that apply to commercial insurance. So there's going to be a new definition, which has sometimes caused a bit of confusion in the past. So will be easier for firms if they do want to apply that definition. So some commercial insurance won't need to be subject to those rules. Also allowing a lead firm to take responsibility for product design and approval. So I think that's a really interesting one, following on from consumer duty and co-manufacturing and so on. So a lead firm there would be able to take compliance with Prod 4. Disapplying some of the rules for bespoke products. So again, that might be a slight easing off for firms, and the requirements really about the sort of standard insurance contracts being subject to those rules. And the final three sort of changes that we're expecting to see there will kind of take together, because it's sort of about slightly easing up in terms of the specifics of the rules, giving firms a little bit more bandwidth to focus on the outcomes. So kind of more similar to consumer duty. So letting firms determine the frequency of product reviews, so removing an annual requirement, removing one of the notification and reporting requirements, so one less return to submit on employers' liability insurance, and then also removing minimum required hours of CPD for employees. So of course, employees will still be expected to be kind of properly trained and do their ongoing training, but removing some of the specifics and leaving it to firms to determine what's appropriate. So that'll be relevant for kind of all insurers, Lloyd's managing agents, insurance intermediaries, and funeral plans. And then, yeah, just to reiterate that once the consultation paper closes, the policy statement will be kind of towards the end of the year, and the rules are expected to take place to sort of apply immediately. So moving on to pure protection market survey. So I said earlier that there would be a couple of areas that touch on fair value, and this is another one. So this is a survey looking at kind of scrutinizing whether pure protection policies provide fair value. So formal engagement is planned through 2025. An interim report is expected in Q4, and further engagement, which I'm assuming will be kind of good and bad practices and maybe some changes in H1 next year. So the areas of focus, just for some context, in 2023, 4.85 billion was paid out on individual policies on bereavement, illness and injury. So the types of insurance in scope here are as term assurance, critical illness, income protection, and whole of life. So the focus is really to try and understand how well the market is functioning and whether customers are receiving good outcomes. Marianne touched on commission levels in the space of motor finance, and commission levels are kind of being looked at here as well. So, you know, areas like switching, churning, that sort of thing, and our customers really getting a good outcome as a result of all that. And also looking at some areas like guaranteed acceptance for over 50s, which, you know, on the tin sounds like a good thing, but not if premiums are sort of disproportionately high and potentially impacting vulnerable customers. There have been some departures from the market too, so the FCA also looking at competition concerns. So I think actions for anyone in that space and providing those policies is a focus on data, collating it, summarising it, and being prepared to present it. And then finally, I'm just going to touch on the life insurance stress test for 2025. So that was launched in January and submissions are expected in June. Similar to the test in 2022, the focus will be on bulk purchase annuity providers. So relevant for PRA authorised life insurers, and the focus here is on financial resilience. For any firms that are in scope of that, the PRA's published an approach to the list document, and that can be read alongside the guidance. One point to note as well is that the PRA will be publishing individual results for 11 major annuity providers rather than just aggregated results, although they will have aggregated results too. So one to watch there. And the overall objectives will be assessing the sector and individual firm resilience to severe but plausible events, strengthening market understanding and discipline, and improving risk management vulnerabilities. So that wraps up the areas that I was going to go through, and I'm going to hand over to Hilary now, who's going to take us through wholesale financial markets, retail investment, and investment management priorities.
Morning, everyone. I am the team's knowledge and development lawyer, and I'm looking forward to speaking to you this morning about some key topics in this area of the RIG. Starting with the wholesale financial markets piece of the RIG, this is 13 initiatives in there, and I've picked out a couple to focus on, which are also new. So the first big ticket item here is the UK move to T+1. In February, it was confirmed by the government that the UK market will move from a T+2 to T+1 settlement period for listed stocks and bonds, and that this will happen on the 11th of October 2027. And the government now had to legislate for this. It's worth also noting that the EU and Switzerland are going to move to T+1 on that same date. The confirmation from the UK government to do this move is on the back of the publication by the Accelerated Settlement Task Force of their report detailing an implementation plan and UK T+1 Code of Conduct. The merits of faster settlement are very clear, and there's strong government and UK regulator support for the move. And the message from the regulators and trade bodies is that firms should act now. And indeed, the most recent study from the task force, which was published yesterday, shows that almost 2/3 of the global investment industry is now preparing for the UK move to T+1. In terms of some other recent updates linked to this moving to T+1 on the securities side, last Thursday, 3 main UK financial services trade bodies joined forces and issued a recommendation encouraging firms to alter their fund settlement timings to T+2, so that would be from T+3 or sometimes T+4 to T+2, and also to do that move on or before the 11th of October 2027. T+2 was identified as the optimal date for fund settlement in the task force report, so it's not so unsurprising. And the FCA has also put out a statement welcoming the industry body's recommendation, and again urges funds to plan early to deliver this transition. We'd love to hear firms' thoughts on last week's push to T+2 for funds, so please do reach out if you'd like to discuss. The next topic I'd like to talk about is on the retail investment side. There's 2 initiatives listed in the RIG on that, and I'm going to focus on the larger one, which Jamie signalled up front in his start of the webinar as well, which is the replacement of the PRIPS regulation in the UK with the FCA's CCI regime. So the CCI regime is a new retail disclosure regime with various aims, including being simpler and giving consumers better information. Examples of CCIs are open-ended and closed-ended funds and insurance-based investment products. The proposals are far-reaching across FS firms, as the rules will apply to those who manufacture or distribute a CCI to retail investors in the UK. It's going to have a large impact, as the FCA notes that 23% of all UK adults currently hold a CCI. So there's been 2 consultations so far from the FCA on the CCI regime. We had one in December, which covered the products and scope and key principles. And then there's been a more recent further consultation in the middle of April this year, proposals around the new regime. Very interesting key parts of this paper is a revised transaction cost approach and the proposal to remove implicit costs. Now, unsurprisingly, this proposal has got strong industry support, given the struggle that industry has had with calculating implicit transaction costs since PRIPS. However, if it goes ahead, that will be an area of UK and EU divergence, which can be tricky for firms to manage. Interestingly, the FCA also discussed their approach to transitional periods, so when will be the regime is going to start applying. So the FCA confirmed they will consider feedback from both consultations to make their final decision. However, they do think they're going to adjust their original proposals so that the regime will come in force for all firms at the same time. So the FCA are continuing stakeholder engagement on this new regime, and we can expect to see a policy statement in late 2025. So definitely one to watch out for. I'd lastly like to move on to the investment management side of things. There was 8 initiatives listed in this part of the RIG, 3 of them being new, and I've picked out the 3 which I think are of key interest to this sector. The first one is the FMD review, and the aim of that in the UK is to make it more streamlined and tailored to the UK market to support UK growth. So similar themes we've seen from other regulatory change earlier. We've had 2 key publications in this space recently. Firstly, the government's consultation on the AIFM regulations. So that focuses on the legal framework and specific proposals include removing the legislative thresholds for small and authorised UK AIFMs, and that all listed closed-ended investment companies will remain in scope of the AIFM regulations. In terms of what the FCA is doing, well, this is the same time, on the same day as the government published their consultation, the FCA published a call for input on the AIFMD review, which is intended to give the industry clarity about the direction of their reforms, and they asked for feedback on areas such as the creation of 3 levels of firms based on their size and rulemaking at each level. So both the consultation, the government consultation, and the FCA input close for comment on Monday, so there's only a couple more days to get comments back if you're looking to respond. In terms of next steps, and depending on the outcomes of the consultation, the government will publish a draft SI for feedback. The timing's not too clear in that, but I assume it'll be late 2025 or in 2026. And then the FCA is also planning to consult on detailed rules on this, which we'll obviously be looking forward to seeing in the first half of 2026, which is dependent on what the Treasury also decides to do. But the FCA have helpfully committed to providing more details on implementation timeline. One last point, again, this is another area we're potentially going to see large UK and EU divergence, which again may be challenging for firms if they have UK and EU AIFMs. And just a couple of points before we close. I will just quickly flag on the investment management side, because I think they're again important ones. So fund liquidity risk management, again, this is a remaining ongoing global regulatory focus. So I just wanted to flag we can expect to see an FCA consultation on this in Q4. There's only high-level details on the reg around about that, saying it's going to pick up IOSCO and FSB proposals, but I think it'll pick up the IOSCO proposals on which were published in May, and also some 2022 proposals from the FSB on structural vulnerabilities from liquidity mismatch in open-ended funds, and that's what I expect will be picked up there. And the reg also confirms that it will incorporate residual SCA work on open-ended daily dealt property funds. One to watch out for as well. And finally, I just wanted to quickly flag we can expect to see some changes in the streamlining of the assessment of value reporting, and the FCA have committed to reviewing their assessment of value reporting in call, and that a consultation on that will be published by December. So hopefully that was interesting for everybody, and I'll hand over to Jamie now in case there's any questions in the chat or if anyone has anything to ask. Thanks.
Thanks very much, Hilary, and thanks everyone. I don't see any questions in the chat, although I still can't see the slide deck, so I may not be the one to rely on for that. But if you do have, we've reached the end of the time anyway, but we really do want to hear from you. So if there's anything you've heard today that you want to have a chat about, or if there's any feedback or comments on particular topics, please get in touch. We are on LinkedIn, of course, and we're regularly sharing our alerts and insights where we go into some of these topics in much more detail. Yeah, so I think with that, thanks for sticking with it to the end, and hopefully see you next time. Thanks, everyone.